Marcus Crowick is a business coach, profit-first professional, and entrepreneur with over 40 years of experience helping business owners take control of their finances and build profitable, stress-free businesses. In this podcast, you'll get real-world strategies and practical insights to grow, increase profits, and create financial stability. Whether you're a tradie, a startup, or an established entrepreneur, Marcus's straightforward approach will help you build a thriving business. This is Business Unlocked.
Hello and welcome. On today's episode, we're going to be looking at pricing, the true cost of wages in your business. And we're looking at that because when you understand the true cost of wages in your business, then you can work out what your pricing has to be into the marketplace. Your wage costs and pricing are something that you should be looking at all the time, particularly relevant at this time of year. The podcast is being released at the start of July, so the start of the new financial year in Australia. And it's a great time, if you haven't already done so, to be going back and having a look at all of your expenses, having a look at your pricing into the marketplace, having a look at the profit that you want to make, and of course, reverse engineering that back into everything that you're doing in the business. It's also particularly appropriate at the moment because we have just undergone a 3.5% minimum wage increase in Australia. So that kicked in on the 1st of July, as well as an increase in the superannuation guarantee from 11.5% to 12%. So they're all added factors going into the wages that you're probably paying. Now, we will ask the question, do you have to pay that wage increase or not? And there's a yes and no answer to that. The first question that comes up there is, why is pricing so important? And the short answer is you have to make enough. You have to make enough money out of what you do to pay your employees. So that's the wages we're talking about. Pay all the other expenses. So pay your bills. You have to pay your taxes. You have to pay yourself as an employee of the business, and also pay yourself and whoever else is involved as a shareholder of the business, which is a different thing. You've invested money in the business and time in the business, and you get to be rewarded, not just because of the work you do in the business, because of that investment, just like in any other company that you might go and hold shares in, you deserve to be rewarded with some profit in the business. So your pricing has to reflect that it's going to pay all of those expenses and leave you with a profit. And preferably that the profit is reversed engineered into what you're doing so that everything's covered and the profit is taken care of up front. And it mightn't sound like much when we're talking about a 3.5% increase or a 0.5%, 11.5% to 12% increase for superannuation. But I just want you to look at these calculations here, and the calculations are this. The wage in 2024, if we said $100, because that makes the maths easy for us, and the superannuation guarantee was an 11.5%, then that made the superannuation cost on that $100 $11.50, and that added up to a total cost of $111.50. Go into 2025 with that 3.5% wage increase. Now that $100 base wage is $103.50. We have a superannuation guarantee of 12% on top of that, which gives us a superannuation cost of $12.42, not $12 because it's now being paid on the increased wage. So our superannuation cost is $12.42, leaving us with a total cost of $115.92. Now, I know you might be trying to imagine this all in your head. So let's just say it's $116 to $111.50. So it's roughly a $4.50 increase for every $100 in wages that you were paying before. So the actual cost in a percentage wise is 3.96%. Now, this makes a substantial difference to you if we work on the model that's commonly used where it's thought of as businesses making a 10% profit. But often that profit, that 10% profit, is actually the taxable income profit. So it's something that comes from your profit and loss, basically, and your accountant does do some work on it, but there's this generally held idea of a 10% profit. Now, if you're watching this on video, I also have a pie graph up that shows that, often wages might be 35% and expenses 35%. I use from when I interviewed my great mate Ignatius Mendonça that he carried about 20% rent. So I've just put those into a pie graph for this to make a little bit more sense. But the 10% profit idea. So let's stick with that. What does that mean? Well, that's the profit before you pay your income tax out of it. And often it's the profit on the taxable income, but there's other payments that we find, and we deal with this in Profit First all the time. There's all these other payments that you might be making. So cash going out of the business that isn't recorded in this profit and loss. Often that would be owner's drawings. Often it would be loans that you've got. So for instance, if you have a vehicle loan that's coming out and the loan in itself, the repayment of that loan is not tax deductible, so that doesn't come off your profit. Now, I'm giving a simplified view because people might say, well, yeah, but there are things like the depreciation. Yes, that's all taken into account, but just bear with me on this. So using this idea that wages are 35% of your bill, if we increase them by 4%, just the superannuation and the wage increase here, it's 4% of the 35%. So we're going to make that easy. 10% of the 35% would be 3.5%. If we just halve that again, so let's say 5%, 10% of the 35%, if we use that $100 thing, $35, that would make it out of $100 is going to wages. A 10% increase would be $3.50. We're looking at a 4% increase. So let's just halve that $1.75. Let's call it about a $1.60 increase. So that's 1.6% increase to your overall costs from a 4% increase in wage cost. Again, if we go back to the idea that profit is 10% of the business and you've just taken 1.6% out of the profit, if you don't change anything else, 1.6% has got to come from your profit. 1.6% of the 10% is a 16% change in the profitability of your business. That's huge. If you're not making that money, and again, we've got to take tax out, we've got to take other cash payments out. I did this with a client last year, and we took his 10% down to about 2.7% was the reality of what he was getting. So if you're cutting this out, taking 16% out of your profit, that's a lot. And that's given that you're making a real 10%, which you're probably not. So coming back and reviewing your wages and what the real cost of your wages is, and applying pricing so that you can keep up to date, so that you can pay all your other expenses as well as get your profit right. It's not just about you making money, but you're going to have to pay all these other expenses as well that are also going to be impacted. They're probably going up. So we've got to get this pricing right and have a look at the impact on your wages. Number one question then that comes up is, do I have to pay this increase? And the answer is yes or no, depending on your situation. We always have this idea of it depends. So if you're paying the minimum wage or the award wage, you're probably going to have to pay this increase. So if the award says $25 an hour, and that's what you're paying, then you're going to have to pay the increase. It's mandated. It's a general increase based on awards and the minimum wage. However, if you're paying above that, you might not have to. Now, I'm going to just pause here and say payroll is an incredibly complicated area. You might have somebody in your business doing it. You might have your bookkeeper doing it. And there's various levels of expertise in your bookkeepers. It's really not something that your accountants deal with. They're really there to look at tax. And whilst they might give you some advice on payroll, the people you really need to go to are experts. I was at a conference once, a payroll conference, like a payroll section of that conference. And one of the leading providers of payroll services in Australia stood up and said, you can could ask 20 of us a question and you'll get 20 different answers. And we see with big organizations, I was just watching TV this morning and they were talking about the increase in wages and the fact that some large organizations have to make back payments like $15 million, $3 million, items like this, because they've made errors in their payroll. Not because they deliberately set out to rip off their workers. Simply, they've made an error either within their system somewhere, it hasn't calculated something properly, or they've made an error in determining how people should be paid. So be very, very, very careful of making these determinations. So if you've got a great bookkeeper who really does a lot of payroll or runs your payroll, they might give you some advice. And otherwise, I'd say, talk to an HR expert in this regard to get advice from them on whether you have to pay or not. They're really worthwhile having in place. I've got an HR expert coming up in some future episodes, so listen out for that. But do be aware of this. Whilst we're told that people don't leave jobs for money, that's certainly not the number one cause of why they're leaving jobs. It's normally, not until number 5 that it comes up. That people expect to be paid a living wage. And it's a critical human need that people get paid enough money to service their physiological needs. If you're aware of the thing called Maslow's hierarchy of needs, the lowest level of that, the first need that has to be addressed is physiological. So that's things like food and water and some of the other things we need in our life, which we won't go into here. But, people need to be able to get paid enough money to be able to live. And in Australia, we tend to do that from one job, not having to go and have 3 jobs, although you might think that's not the case at the moment. And simply, if you don't want people resigning because you do value them, if you want them to be happy workers, you're not only going to take care of those basic needs, but you're going to value them as an employee and pay them what they're worth. And if people are thinking that the general thing is that there are pay rises out there, then they're going to be looking for one. And of course, you should have pay reviews built into your ongoing reviews with staff, at least annually for the pay part of that review. So let's have a look at the 5 factors to determine price. It's really the 5 factors to determine the real cost of wages in your business so that you can have that true cost in place when you're determining your price. And factor number 1 is building in the simple on costs, and we've already mentioned one of those. The first on cost that you've got to be built in is superannuation. So that's guaranteed to the employees by the government that you now have to pay 12% on top of whatever you're paying them as salary or wage to look after their future. The second one that you've got to build in there is workers' compensation. Now, that will vary industry by industry, and it also varies how that takes place from state to state. In New South Wales, where I am, a code's assigned to your industry, and it could be 1%. It could be right up there, 8, 9, maybe 10%. All depends on the industry, but you've got to add that on to the wage that you're paying the person. So we've gone from, if you're paying them $100 in wage, they've got to have 12% super on top of that, and then they've got to have whatever that workers' compensation percentage is on top of that. And the third area that comes up is allowances. It's all sorts of allowances depending on the industry that they're in. Often comes up with trades, and you've got to make sure that you're taking care of the allowances, that they're built into your pricing. So be aware of all of those. It's amazing the sort of allowances that are allowed in some industries. If you haven't gone back and checked the award for that, hadn't an expert check the award, highly advise that you go back and do that. The next area that comes up is the time available to work. And there's a few different parts of this, because we often think when we're having a look at how much it costs, and we're trying to go back from what are we paying the person per hour, we go forward, and then we look at the year and work backwards. We don't take into account when they're actually working. And what we mean by that ultimately is how much they're billing out for the day or how many hours in a day they're actually billing out. The easiest way to think of this is somebody who gets paid an hourly rate, and when you charge an hourly rate, that they, out of the day, how many hours are they actually billing out, even though they might be busy for 8, and we'll come to that. Salary is the same thing. You see it in movies all the time where they talk about billable hours for lawyers and whatever, very common. It's really important. So how much time do we actually have available to work? So the number one area that we have to take into consideration is holidays. So in Australia, we're given 4 weeks holiday a year. So all of a sudden, your worker doesn't have to make up their salary for the year in 52 weeks. It's actually got to be made in 48 weeks. So when you're looking at that hourly wage, it's not a matter of simply saying, I've got to bill enough in the hour to make up for that hour. We're also saying, well, hang on, there's 4 weeks of the year when they're on holiday. You've got to bill enough in this hour to pay for that 4 weeks as well. The next factor to allow for in people billing out is personal leave. So again, in Australia, we're given what used to be called sick leave, now personal leave. We're given 10 days personal leave guaranteed. And that can be taken for all sorts of reasons, doesn't really matter at the moment, but we have to allow for the fact in our wage costing and therefore our pricing that leave might be taken. So we've got the 4 weeks annual leave, those 20 days. Now we have another 10 days of personal leave that somebody might be taken. Not only that, but in Australia, we have roughly 10 public holidays a year, and you've got to pay your employees for that. So all of a sudden, we've gone from thinking we've got 52 weeks in order to pay all of these expenses. And it's not just your wages, it's all your expenses. We're now down to 44 weeks of work has to pay the expenses for 52 weeks of the year. And the next area that we have to look at is productivity. And what we mean by that is what I was saying before. In a day, whilst we might think of the idea that we've got 8 hours work to do for the day, it's how much of that work that we're doing is actually producing billings. How much is being charged out to the client to pay for what it is that we have to pay for. So if I use that hourly rate example, let's say it's a plumber and the plumber has 8 hours. The guys go to work for 8 hours a day. Are they actually billing 8 hours out, or are they only billing 6 hours out? We know that there's so many things to get through in the day, and not all of them often are things that we're able to bill for. So we aim for, roughly 80%. To make it easy in this example, let's say that we're aiming for 75%. So if it's 8 hours in the day that we have to work, that 6 of those hours might be billable. Again, what it means to us is that 2 of those hours aren't billable. We've gone from saying we have 52 weeks to pay for all of this to saying I don't have 52 weeks because I've got to take out my holidays, my personal leave, my public holidays. We're back to 44 weeks. When I then bring that back to a weekly or a daily rate, I now also have to allow that I'm not getting a full day of billable work. Doesn't matter how busy people are, so many things to do. Not getting a full day of billable work. I'm only getting a certain number of hours. So if it's 6 hours out of the day that are being billed of the 8 that somebody's at work, then I've got to take into account and again divide that out, which is going to make my actual hourly rate, my cost per hour, and therefore what I need to charge out higher again. And then the last thing that I have to take into account is back to all of these other expenses that we've got built in. So we've been talking about wages, the true cost of wages, but when it comes to pricing, I've also got to take into account all of the other expenses as well as the profit I need to make this whole investment of my time and money worthwhile, I've got to reverse engineer that back in. Basically, what I say to people is think of that as an expense. We've got to reverse engineer that back in so that we're making the money that we need to make. We've taken into account all the expenses in the business. We've gone through and worked out that we've only got 44 weeks to pay for it. Worse than that, on any day, we're probably not able to bill out all the hours in the day for the people who are billing it out, because they've got to take care, in those expenses are the wages of the people who aren't producing money. That might be, somebody, an operations manager that's in-house doing allocations and things. They're not actually out on the road billing out the money or carrying out the physiotherapy. It might be the receptionist who's dealing with people, but they're not actually, producing the billings, if you like. We've got to take all that in account to make sure that we have the right pricing determined to give us, again, the profit that we want. So what are the 5 factors to determine price? Well, it starts with your on-costs. And the first on-cost is superannuation that you're guaranteed to have to pay to your workers. Make sure you bill it in. The second on-cost is your workers' compensation, whatever it happens to be for your organisation. The third on-cost is allowances. What allowances are there in your industry? The next factor is the time available to work. You've got to account for the holidays that people are given each year. You've got to account for the public holidays that we're all entitled to and get paid for. You've got to account for people's personal leave, 10 days a year that they're entitled to. Even if they don't take them, we've got to make allowances for them in our costings. We have to allow for productivity. How many hours are people actually able to bill out, or products are they able to sell? Whatever it happens to be, what's the productivity of people in your business? Does it run at 75%, 50%? And that's got to be taken into account when we're determining the actual cost of their wages so that we can work out our pricing. And then there's our other costs. We've got our direct expenses involved with people doing the work. So with somebody like a tradie, it might be fuel going in the vehicle to go out to site, or there's the fixed expenses, things such as rent that gets involved. But all of our expenses, whether they're fixed or direct or variable, have to be taken into account when we're determining the true cost of employing somebody, because the person doing the work, producing the billable hours, is that money is what's paying for everything in the business. And of course, we have to allow for profit in that. So there are our major factors that we have to take into account when, again, I'm repeating myself, we're working out the true cost of wages in your business so that you can work out what you really have to be charging, what your pricing has to be to not only pay all of those expenses, but to pay you, pretty importantly, and to make a profit for your business, which ultimately, and really in the first place, is what it's got to do. In the first place, it's got to do that because if it's not making a profit and not paying you, we might as well go and get a job somewhere else. If you want to get some great advice on that, pretty simple. We offer at Business Unlocked pricing clarity consultations. Just email me, success@businessunlocked.com.au, and put in the subject pricing, and I'll get back to you to have a chat to you about whether a pricing clarity consultation is the right thing for you. Thanks for joining us today. Look forward to you joining me again on another episode.